Welcome to episode 20 of the Minds Capital podcast, the show devoted to the growing world of independent sponsorship and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Nicholas James and Max Lummis. Today's conversation is with Neal Doshi of Forged Capital, which currently has 4 companies in its portfolio. Max, what struck you in our conversation with Neal?
There's a valuable lesson in the conversation with Neal, a very valuable lesson. So early in Neal's career as an independent sponsor, I believe it was his first deal, he had a capital provider basically retrade the equity terms with him at the 11th hour. In fact, they basically converted what was going to be an equity investment into his independent sponsor deal into Neal receiving more of like a broker or investment banker fee, closing fee for the deal. So he is careful on how he words that, but basically he got cut out of the deal. He did get a fee for it. And the lesson there is quite simple. It's you need to perform diligence on your capital providers before you walk all the way down the aisle with them and get to closing. And I've heard, unfortunately, other examples of this happening with other sponsors. So it's something to perform your diligence on ahead of time, and don't get caught in a bad position where you don't have much leverage at the end of a deal and get cut out of the deal. So the other thing he mentioned that was interesting, he didn't talk a lot about it, but when he was talking about his investment criteria, he mentioned that they do not invest in deals in California. And Neal and Forged Capital, they're very focused on labor-heavy businesses. So California is just notoriously not a real employer-friendly state for a lot of reasons. There's a lot of compliance. There's high labor costs. There's unions. That's something that again, I've seen with other investors and in our own investments. We're a little leery sometimes of deals depending on which state they might be in and whether or not it's a business-friendly state. So some good nuggets there with the first point about the capital provider being the most salient one.
Yeah. I've heard on the aversion to California. I've also heard that quite a bit, sometimes jokingly, sometimes very serious. Even searchers buying much smaller businesses than independent sponsors. I've heard more than one say, one of my criteria was no California, can't be in California, which breaks my heart a little bit, having lived there and still really loving the state. To the big story in this episode, yeah, it's a really dramatic and disheartening one, and striking that this is not an outlier. Max, you just said you've heard of this. We asked Neal if, as he's talked to other sponsors about his experience, if he's heard of it happening to others. He has. So this is not as unusual as it might seem. So I think we're adding a lot of value by amplifying a story like this. Nicholas, what did you think?
Yeah, it really sucks when you hear stories like this. And this is the big vulnerability, of course, of the deal-by-deal model, in that you have to go to many parties in order to rally your deal and put it together. I've seen it several times. One example that comes to mind is a couple of friends of mine many years ago now. Their very first deal, it was a huge deal. The same thing happened. They had to go to a big anchor investor, a big PE fund. And in the 11th hour, the PE fund just said, here's your fee. You can fight us in court if you want to. But you probably should just take the fee and go on your way. And they did. It was a nice fee. They used that fee as equity and was able to be quite creative with deals they later did and have done very well. So this reminded me of Neal. He was able to cash out a little bit and convert that into what is now a successful independent sponsor journey. But more recently, Minds was looking at a deal probably back in the fall. And a few months ago, I was checking in with the sponsor, and he told me that the family office that he had been partnering with had effectively stolen his deal. And he used the word steal. And there was no cash out for him. There was no alleviating circumstances or no consolation, really. He was also a first-time sponsor on his way to close a pretty big setup with 2 or 3 simultaneous closings. And as a first-time sponsor, you're vulnerable. You rely on your capital providers. And you may even have a non-circumvention provision in your NDA. And you would think that would give you legal coverage, but you're stuck in this really difficult position if you're him. Because he might have the legal right to pursue something in court, but do you have the cash to withstand a big lawsuit? You're going to be countersued. It's going to take many years. And you're a first-time sponsor, so you don't have any income. So cost-wise, it's unfeasible. And from a reputational perspective, you haven't yet built a track record. And other capital providers, while they may support your costs, they'll be wary of someone who starts suing their capital providers. So you're really stuck in a very difficult position where you have no leverage, you can't sue, you can't do anything, honestly. So the way with Neal, we talk about how can you increase your leverage in such situations. And the biggest factor, of course, is just track record, more relationships, a broader network. So we really peeled the onion on this. And I think it's a very important topic. It doesn't happen on 20% of deals, probably not even 2% of deals. But every now and then you hear these stories and they are catastrophic for the sponsors that are involved in them.
Well, before we get to it, a reminder that Minds Capital continues to invest equity in independent sponsor deals. So if you're a sponsor raising for your acquisition, submit your deal to us, deal@mindscapital.co. And for those of you inquiring about Fund 2, we haven't started raising yet. We're going to do that later this year. But if you are an accredited investor and are interested, there is a pre-registration form on our website, mindscapital.co. Okay, let's get to this interview with Neal Doshi of Forged Capital. Welcome to Meeting of the Minds, your connection to the growing world of independent sponsors and deal-by-deal private equity. We are your hosts, Will Smith and Nicholas James. Formerly a consultant and C-suite executive, Michigan-based Neal Doshi learned about deal-by-deal private equity in business school and recognized it as a gateway to a more lifestyle-friendly career without all the travel that he had been living before. Neal closed his first deal in 2019 after 2 years of searching. And today, he and his partner in Forged Capital screen 5,000 deals per year. And the portfolio consists of 4 companies across consumer, healthcare, and home services. Neal Doshi, welcome to the Minds Capital podcast. Neal, you stated that having no PE experience or real financial investing career pedigree actually made you a differentiated buyer. You focused more on your operations background, your consulting background. Elaborate on that for us. What did that mean?
Yeah, for sure. So I think most people that are, search funders or independent sponsors come from investment banking, or they were analysts at a private equity shop. So they're comfortable around the financial piece, the modeling piece, and understanding how spreadsheets work. And it's obviously important. But no business runs on spreadsheets, and understanding how to develop culture, build teams, create metrics, tweak metrics. I look at that as an advantage that I had over, other independent sponsors that came from more of a traditional independent sponsor background, which would be, investment banking or something in private equity.
And you have found that to be a strong suit that you can lean on in creating value in your portfolio companies?
I have. I think, the first part of any deal is obviously finding a deal, then signing it up. But once you get into, closing the deal and execution, now it's running a business, really. It's working with, in our case, founders typically to help them grow this business, develop metrics around this business, identify acquisitions, identify talent, whatever, develop culture if there's a gap. And that's really my pure background prior to being an independent sponsor.
Neal, how would you say the playbook differs when you are an aspiring independent sponsor? When you get started, how does it differ coming into it as a former consultant, as opposed to, for instance, if you were a former deal maker or banker?
Yeah, I think step one is a lot of people look at, deals from a financial engineering standpoint, right? How do we put, X amount of leverage on it and kind of juice the returns that way without really understanding that, there's going to be, especially lower mid-market, a higher chance for hiccups in your business. And we look at these deals and we're much more conservatively levered when we look at these deals. And we do that on purpose, saying, look, a lot of times year one may end up being what I call a little bit of a J curve, right? We may bring on some seasoned executive talent, build out some processes, increase our operational expenses, which, lowers EBITDA, lowers margin, but it's a short term because we're looking at it from a 5-year horizon of what we need to get to that exit number in 5 years. And I think at the end of the day, that's how we're looking at it, more from that operational perspective, not from how do we just, financially engineer the return and not factor in the risk of running a business, risk of the environment, political environment, economic environment, you name it.
Do you think this affects your diligence when you look at a target? How do you think your perspective is different from someone who has a pure financial background?
I'm not 100% sure on that. I've never had that conversation candidly from, other traditional independent sponsors. I think we're more selective in the deals, even though we see a lot of deals, we're very selective in the deals we want to pursue, one. And then in the way we value the deal, two. We're very selective in terms of it. You could say we're a little bit more conservative in nature than probably some of our counterparts, but I think some of it is because we're not trying to maximize leverage at close.
Do you look for operational weakness in targets, precisely where you can add value?
I think in the deals, they naturally come, to be candid. We always focus on what I call B assets. So they're lower mid-market, they're growth-focused companies, but there's something missing. Maybe it's a lack of C-suite talent, or maybe they don't have a sales team, or they never knew how to use sales. There's always something missing, so we're always looking for what is that value add we can bring to turn this B asset into an A asset.
You mentioned earlier that lower middle market businesses have a higher tendency to experience hiccups.
Yes.
Is that related to what you meant about B assets as well?
Great question. I know for sure in terms of B assets, there's going to be something out there that's missing. That's required to make it an A asset. And, if you're going to find a B asset at a 4 or 5x multiple, and then you're able to clean it up with just operational work and educating, the sellers on how to get to become an A asset, then all of a sudden, between those operational improvements and growth, whether through acquisition or organic or both, you're now turning this into an A asset in 5-6 years, and you're going to gain a premium multiple, and you're going to get a larger, I call delta accretion on that side. Do I think lower mid-market deals in general have some sort of flaw? I think size impacts a business, right? You can be let's call it an A asset, but you're a 3 million EBITDA business. It's really difficult to get to 3 to 4 to 6 to 10 million of EBITDA, just based on being an A asset, because it takes more than just running a perfect show or perfect business to get there. Because typically those businesses are still, even though they're A assets from a customer concentration standpoint, maybe a leadership standpoint, maybe a service standpoint, product mix, whatever, margin standpoint, you name it, they've optimized everything. There's still something missing to get from that 3 to 10 because they would have been there by now. Because the businesses we focus on, I'll say have been in business for typically greater than 10 years. I mean, we're looking at one today that's been in business almost 50 years.
Okay, I like what you're saying there. So an A asset that kind of checks all the boxes and doesn't have any major yellow or red flags, to your point there.
Right.
There might be nothing to fix. So if you're looking to 2 or 3x your EBITDA, you're saying there's nothing obvious to get to. It more has to happen organically over time. Is that what you mean? That they're in a way harder to grow because they're already so good?
Exactly. So then you're already paying a premium for it. So, let's say it's a 5x B asset, but that A asset's a 7.5, 8x. Now you're still in the lower mid-market. So to get to that next jump, what is your gain? You're going to have to just be growing and Is it organic or inorganic? You may have some margin compression there if it's in, to build out the team if it's inorganic, because you may not have everybody from an integration team, right? You're an A asset organically, but you're not an A asset for growth necessarily. So to get to that level, to be that, that big jump, I think is harder to do at the end of the day versus a B asset where you have a little bit more room. Some people will say, well, aren't you worried about not having a CFO or something that it's going to derail your business? And my answer is, no, I think we can find the talent. I think there's a lot of great talent in the workspace. So I think being able to leverage that gives us more room, because if I'm buying a business at 1x less of a multiple, if you think about it, if it's a $3 million business, I'm spending $3 million less on this business. And obviously a CFO is only going to be maybe a tenth of that cost.
Going back to the questions about consulting and entering private equity, this brings me to think about Bain Capital, founded, 50 years ago at this point, Mitt Romney and a group that came out of Bain and Company and BCG, founded Bain Capital. Effectively, they were saying, look, we're working for clients to improve them strategically. We see the results in case after case many times a year. Why don't we own these businesses? And they raised money and started buying companies based on the premise that they're good at strategy consulting. Right. And as I've seen other consultants come into the lower middle market, I see some of that, but more often I see more, functional expertise that, hey, I know how to increase sales conversion rates, or a guy I know was a consultant specializing on optimizing call centers. I think he was an acquiring mine as well. Yeah. And they come into it with some kind of a niche expertise, and through that particular skill set, they are able to find targets that suit them and flip them. And through that, you can very clearly see the differentiation they bring versus guys who rely on financial engineering. How does that resonate? Or if you were to speak philosophically to that, does that kind of align with how you view yourself as well?
100%. Not to the level of maybe what you were describing initially. There's a subject matter expert in terms of consulting. It's me. You alluded to the call center gentleman. But really, private equity is understanding a variety of businesses, right? Most people are not focused in one single sector, and we're definitely not. We're generalists by nature. We have a thesis, but we're not focused on one specific type of business. So you got to be able to pivot. You got to be able to think. You got to be able to apply your strategy and background, your consulting background, your operational background into all these businesses, right? Without, to your point, financial engineering. And I think that's what's made Bain Capital so successful, right? In their 50-plus year history, is they're able to take that consulting background and say, look, we consulted for this type of business. This was the playbook that got from 13% margin to 18% bottom line margin, that grew business 22%, whatever it might be. Let's just apply it to this business when we acquire them. And that's a very simple, at the end of the day, that's a very similar playbook that we look at. My partner's got 25 years of operating experience and worked all over the world as well as I have. And we're able to kind of go back to our playbook, go back to, our lessons learned from operating organizations to say, what shouldn't we do and what should we do?
Neal, I mentioned your first deal was in 2019. It had a few interesting details, that story. Can you take us through it?
Yeah, we were, at this point I was almost 2 years in, pretty close to 2 years in being an independent sponsor. And I was always told by everyone that, if you want to do this, 2 years is what you're trying to get into. And, at this road, so you're some nerves, right? You want to put, you got to get some money out there, right? Being an independent sponsor doesn't make money until you close deals. And, we had a great deal signed up and we had terms. And then just at the, towards the end of the transaction, and I'll say this isn't unique to just our group, but the terms were changed, materially changed. And, we had two ways to look at it. Let's, go back and go look at the other capital providers that were interested in it and start the process over, or take their terms. And, I think if this was today, I would do the latter, which is I would just start the process over, knowing, the experience I have and having the confidence to get a deal closed. But back then it was, you have to put points on the board. You have to put money on the table. And, our terms were materially changed, but at least it got us credibility that we could close the deal.
When you say materially changed, could you be more specific?
Yeah, I mean, a typical independent sponsor deal is, a closing fee, a management fee, an ongoing monitoring or management fee based on, the company's EBITDA, typically 4 to 6% of that TTM EBITDA, and then a carry. It mirrors a lot of deals, mirror almost a 2 and 20 in typical private equity. Our deal was never the 2 and 20, so but there were all three components of that deal in some way, shape, or form, and I don't know exactly when, but close to the day the deal was closing, the terms were changed that it was more of a buy side type transaction for us. We were almost like a buy side broker, the best way to describe it, where we just received a closing fee.
And let me just interject here to clarify.
Yeah.
The terms were changed not by the seller, that was not the antagonist here, but you had an anchor investor who you relied on to close the deal. And in the last minute, they came in and pivoted on you guys.
That's correct.
So what was the EBITDA of this business that you had signed up?
Let's go through memory. I want to say it's about it was $7 million of EBITDA at close.
So pretty sizable business. It's your first deal as a sponsor, so you obviously need not only a syndicate, but one or two large size investors here. You were able to sign them up. They come along. So how was that dialogue? Did they give any inkling that they were looking to retrade down?
I don't know if they gave an inkling. I think that's hard to say, right? You're in diligence, as we all know, and you're running multiple streams, and you're trying to close the deal as fast as possible, and you're facing pressure from the seller. You're facing pressure internally to get the deal closed. So I don't know if there was any inkling. I think it was, and I don't know if it was premeditated or not, right? I can't look into the eyes of, the individuals that made that decision. But it was just brought to our attention literally through an email of, this is what we're going to now propose, and tell us what you want to do.
And just to be clear about how strong a retrade this was, you had signed up, agreed to work with this anchor investor. You get within spitting distance of closing, with very close to closing.
Correct.
And they essentially say, we'll give you a finder's fee.
Correct.
And thank you very much, goodbye, or we're not in. So they really grabbed the deal from you. Yeah, I just want to kind of underline how stark this was and how aggressive.
Yeah, I mean, I don't want to use the word steal, because that's not true. Because once you agree to finding an investor, you're working on the deal together. So, I don't think that's ever the right word to use. I think it's just retrade's the word we use. I'm sure, and I don't have any anecdotal evidence or anything, that we're not the only independent sponsor that someone's got retraded on deal terms. And, I think, as the independent sponsor community has matured and learned how to be collaborative, I am going to hope that the number of independent sponsors kind of getting deal terms retraded kind of decreases or diminishes over time.
What did the finder's fee look like?
It was really just a closing fee. Whatever our original agreed closing fee was, structured in some sort of, it was just a paid closing fee at the end of the day.
But I think we talked about how you became a buy-side advisor effectively with the way they restructured it. So they cashed you out with the finder's fee. Mm-hmm. I think often you see the Lehman scale is used for these kind of situations, which is 5% of the first million, 4% of the second million, 3%, 2%, and then 1% of every million thereafter. Was it something like that you collected?
No, I'll go through memory. I think it was just 2% of the overall aggregate enterprise value.
Okay, so here we have a 7 million EBITDA deal. Let's assume that you guys bought it for 6x. You're looking at $40-50 million of enterprise value. 2% of this is a high 6-digit number. So You're walking away with at least some cash. It's a consolation price, but it's working capital. So this is why you could stomach it at the time.
Exactly, right? Like two parts, right? One is it's cash. It's 2 years of being without any capital coming in as an independent sponsor. So you need to, candidly speaking, as a husband and father, needed to put food on the table, so to speak. So that's one. But two is, if you want to be an independent sponsor, you have to build out a track record. So you have to show deals, right? And, you know, there's no perfect opportunity. There's no perfect deal, even if it's an A asset, to go back to that, you know, letter scale. There's no perfect time. And I wouldn't go back 6 years ago and change our decision. I think we made the right decision. It allowed us to build some credibility and get other deals done. And I think that's the ultimate goal is, can you show that you can get deals done? And if it means you take it on the chin on one deal, that's okay. For the short run, you lose, but for the long run, you look at it and say you can win.
How have you used this deal in your track record after that? Because you were just paid out, and so you weren't part of the deal after it closed, right? But how did you kind of integrate it into your pitch from that point onwards?
You know, we've always been transparent. We just said we had no active role post-close. And that's the honest truth. We didn't have an active role, so we can't take credit for, you know.
But it still shows to a seller that we had a 7 million EBITDA deal. We capitalized the whole thing. It closed. The sellers are happy. The deal is performing well. Our identification capabilities, our fundraising capabilities are all there, right?
Correct. Exactly. And that's the message that we want to bring, is that we can do the full cycle. We can source the deal. We can value the deal. We can sign up the deal. We can find the investor. We can close the deal. And that, you know, that part is essential to becoming a long-term successful independent sponsor.
Did you consider legal options when you were in this quarrel with the capital provider, or when they delivered the new term sheet? Like, what was your instant reaction? Was there any back and forth, or did you just have to take it or leave it?
No legal action. That's just not how we operate. You know, I think you get to legal reaction, then what happens? You know, and I don't know what kind of case we would have had, right? We didn't have any, you know, the deal hadn't closed, right? You know, it's just like any negotiation. Yeah. So I'm not sure what, you know, 2 feet we had to stand on. I think it's just negotiation. In the second part, you know, was, and I'm going, no, this is 6 years ago. If I remember correctly, it was just an email that was really sent to us. I think there was a follow-up call, but initially it was an email, and then we scheduled a call to discuss.
Neal, did you have the impression that I know you don't want to, your impression now, because you don't know one way or the other, that this was a playbook they were running on you, or they decided midstream to do this?
I honestly don't know. I mean, if I were to guess, it was probably part of their strategy, right? You know, you don't think of new strategy overnight, but I can't say for certain.
Yeah. But your hunch is that?
Yeah, my intuition says that.
But to your point earlier there, they didn't actually breach a circumvention clause or the NDA. They just said, we're out, right? So what can you do? You don't want them to run away. They're not stealing your deal or going independently. So to your point, there's no legal option at that rate, right?
I mean, not that I'm aware of. We didn't ever explore it. And again, I'm not a litigious person in general. So it was more about, hey, look, yeah, you're upset. 100%.
Yeah.
But what lesson can you learn? What can you take out of it? What could you do differently the next time? And that's really after the initial, you know, let's call it, you know, disappointment / anger wore off. That's exactly where my mind went.
And what did you do different next time going forward?
The first thing we did is, once we selected a capital provider, we signed a term sheet with them. So now it's binding, right? So now, and then we would share that with the seller. So because the seller has to understand how the whole team works. So now you have various stakeholders. And if you retrade on me, theoretically, our logic is, and what confidence is the seller going to have in you? Mm-hmm. And I think, you know. And
do you diligence providers now as well? Do you call around other sponsors they've worked with?
I do. You know, the independent sponsor community is great. It's a very collaborative community. So if it's a new capital provider we've never looked at or deals with or had conversations with, I'll reach out to people I know in the community and ask if they've done a deal with this group and what their interactions have been and how it's gone. And I've had other sponsors call me on the same thing, on the same topics.
You said earlier that it's been 6 years, right? And so the independent sponsor ecosystem has matured, and you hope that in itself has perhaps lowered the chance of this happening to others. What did you mean by that?
Yeah, I think now, you know, there's other independent sponsors I regularly talk to. on a quarterly basis. And, there's a really good database of independent sponsors, that are, and, if, like I alluded to, if there's a deal that comes on and we sign it up and we get a capital provider that's interested in working with us, and if I've never really talked to them, or, and this is my first real foray into working with them, I'll send it out. I'll talk to some independent sponsors, and just ask them, have you worked with A, B, or C? And conversely, I'll also ask the capital provider for references and say, give me, a deal or two with an independent sponsor. Because at the end of the day, it's a two-way street now, which I think is great. I think, they have to analyze us as the sponsor to make sure that we're capable of, not just sourcing the deal, but growing the business post-close, and that we are who we say we are. But at the same time, we have to vet them out as well.
And I'm curious, Neal, when you've kind of informally vetted or reference checked capital providers on your subsequent deals, is the cross-section of feedback on capital providers generally decent, good, bad, mixed? Or, I mean, if you had to, because now you have a little bit more data, admittedly, it's only anecdotal in your experience, but I'm curious how much of an outlier, if at all, even, that first capital provider was.
No, there's been other capital providers, other independent sponsors have talked about in the same light, that they were down to let's call it the 5-yard line, to use a football analogy, and all of a sudden kind of a bait and switch on the terms. So they're not unique. It's negotiation's all about leverage. And, if you've never done a deal and you don't understand, how a deal operates, the intricacies of negotiation at the end, and that's not saying that you don't know, negotiations. It's just that intricate part of it, because you've never done it. 6 years ago, there was no community for me to go to, outreach to. Today there is. So, the next time I have a deal that I have signed up, and if, I'm at the 10-yard line and for some reason they try to switch the terms of the deal because of something that, let's say it's not material to the deal, right? So let's say it was a 10 million EBITDA business, and we signed it for 50 million and we asked for a 2% fee. If that deal now was, let's say 9.5 of EBITDA at that same multiple, we'd expect the fee to lower based off that straight percentage. And we're okay with that. But if it was something different where it wasn't just pure math, let's call it, we'd go back and we'd talk to other sponsors and see, and, even talk to attorneys that are independent sponsor friendly to see, okay, what can we do? What should we do, so to speak? But that ecosystem has really evolved over the last, since I started, over the last 6 years.
If you said that if you're at this happened at the 5-yard line. So let's say you're an independent sponsor today, you're under LOI, you're about to close, but you're now at the 15-yard line. So you're not quite at 5 yards. What characterizes a situation where the anchor investor can pull the rug under you like this? Like, what are the things to look out for?
Sure. If, let's say that, let's say financials came back weak for that last quarter, right? Or customer concentration picked up. There's a reason, an inherent business reason, then we got to think about it, right? We may restructure the deal, which would restructure our terms. And to your point at that 15-yard line number, that makes a lot of sense. But, good capital providers that are independent sponsor friendly, it's a collaborative conversation. And it's going to happen. It happens in lower mid-market deals. I don't think any QV has ever matched what the sellers represented financials show. It's not going to be there, right? It's the point of view of the seller, especially around ad backs versus what the buyer thinks ad backs are. And, typically there's some sort of negotiation in the middle, but that's going to lower your total enterprise value. And then proportionally everything else goes down.
You said negotiation is about leverage. Mm-hmm. How can an independent sponsor increase their leverage vis-a-vis their anchor equity investor?
So for us, whenever we look at a deal, we try to have multiple capital providers interested in that deal. And we won't sign up that capital provider until we're confident, that group has gone to their investment committee with our materials, typically, right around QV or just before QV, depending on the timing of the deal. But we'll make sure we have multiple capital providers. We'll make sure they've gone through their IC. And then, and that's really, and then we'll make sure they've had a call or a meeting with management face to face. Because to us, those are the three big keys, right? I'm not worried about legal diligence that much. I'm not worried about market study because there's nothing I can control at that point. At that point, we're at the 20-yard line or the 15 or something like that. But I want to get to that stage, and then it's okay. They've done their diligence. They like this deal. They're ready to move forward. Let's make sure, there's no other hiccups. These are the final terms, and let's move forward to close.
What else can you do to increase your leverage?
I'm not really sure there's much. I think inherently, right, if you think about it, the person with the checkbook is the capital provider. So they control the flow of dollars, right? So inherently they have a little more leverage to start. So how do you gain, that leverage back? It's having more capital providers that are interested in the deal. But you're never going to be, to your point, at an equilibrium at the end of the day. Not until you can sign up that term sheet. But there are also, and I'll say this, there's plenty of really good capital providers that are independent sponsor friendly, that are handshake people, that, they set out terms and they don't deviate from them, in terms of the structure. And it's great. It's wonderful.
Right.
And, it makes our job very collaborative with them. And everyone's working in the same page, and no one's, let's call it, looking out for their own, but rather we're all looking to close.
No, I think that's the crux, right? If you're in a position where you feel like you need to increase your leverage versus your prospective partner, capital partner, the premise is wrong, right? You shouldn't want to be in a situation where you're scrambling to increase your leverage. That's not the collaborative partnership you're looking for. Right.
I mean, a deal with a capital provider is, and a seller is it's a marriage of some sort, right? It's a 5-year, our model is 5 years and then look to exit. So it's almost a 6-year type relationship. If we're starting off without trust, I think it's really difficult then to be aligned to grow this business post-close. And at that point, nobody wins, right? The capital providers going back to their LPs saying this deal didn't return, 2x, 1x, whatever the capital was that they were modeling out, right? The seller's frustrated because, the amount they rolled didn't materialize to what they assumed. The independent sponsor, us, we're really frustrated because, one, we don't get to say that we had a successful exit, but two, monetarily, carry is where you make your money in our field. And if you didn't have a 2, 3, 4, 5, 6x type return, you're just not making that much money.
Neal, I mentioned the 5,000 deals that you had forged screen every year.
Yeah.
Tell us a little bit about the process there and how you all generate and then process so much volume.
Yeah. So we have, to use an old school word, we have a Rolodex of brokers and small investment bankers, though I don't think anyone uses a Rolodex anymore, that we, they send us deals quite a bit. We do some outreach, typically on a quarterly basis, just to keep them kind of top of mind. And then we'll just have some regular calls from time to time where, there's some good brokers or bankers that have sent us deals. If we don't see anything for, let's say, a couple of months, we'll call them and say, what's going on? Don't, forget about this, so to speak. But it's turned into really a well-oiled machine now. Of the 5,000, we're not looking and doing IOIs on anywhere close to that number. We wouldn't have the capability, bandwidth, whatever you want to call it, none of it. But we set up, almost like a checklist is the way I describe it in terms of the deal, right? What's been the growth profile? What's the margin profile? Customer concentration? What's the seller looking to do? Those are 4 quick ones that we look at. And then, when I say margin, I'm specifically looking at gross profit. And then I look at, what is their motivation to sell? And if it's, I want to leave the business, but I'll stay on because the banker broker that told us to stay on, then we're walking away because we need to have a partner. And, unless there's a mitigating reason, maybe the seller's 85 years old or something, and he or she just wants to retire, which I can respect at that time. We want our sellers to roll equity. We want them to be part of that second bite of the apple. So all of those are part of our checklist, so to speak, that we can screen out pretty quickly. And then, I guess maybe I should start by saying it's got to be part of the sector of service that we focus on. While we're generalists, and I do agree we're generalists, We are what I call essential services including food and beverage generalists. So we're not looking at manufacturing deals. We're not looking at, SaaS type deals at the end of the day. So we do have a criteria we focus on as well that allows us to screen, a good portion of deals away.
And is that screening done by you at the partner level, or is it done by somebody below you? Is it automated in some way?
In some ways it's automated, in some ways, but a lot of times it's done by the partner or myself, right? Because he and I have to look at these deals and say, what do we think of them? We have analysts that'll kind of look at the deals initially, and they can scrub out some of them pretty quickly, right? If it's an automotive manufacturing deal, it's not something we focus on. They can delete them. But he and I will take deals that we think kind of fit our bucket and review them and make that decision together during our weekly meetings.
I think you had mentioned on the pre-call that you have a 6-point checklist, and I heard you mention sector, motivation to sell, financials. For that, were those all part of the 6-point checklist?
They're all part of that 6-point checklist, right?
And what are the remaining 3?
Well, part of it is growth, right? Is this business growing? Are we buying this business at the apex, right? They went from, let's say, 2 million to 6 million of EBITDA, and now they want to sell, or have they been steadily growing? Or conversely, did they go from 6 million to 3 million of EBITDA, and do they want to sell, so to speak? So that's up there in terms of that. Gross margins, typically we're looking at deals with a 30% gross margin. May look at something in the high 20s, depending on the type of business. And we're looking at EBITDA margins in the double digits. So that's 2 parts of that checklist. Sector matters, location matters. We won't do anything today outside of the US. We don't focus because most of our businesses have a very large labor component. We don't do anything in California either. So those are some other of those, part of our 6-point checklist.
And Neal, with the 4 companies that you have now in your portfolio, where is your capacity constrained? Do you not have the capacity for another deal now, or are you deal flow constrained, just waiting for the right deal to come along and you're prepared to add another to the portfolio?
It's the latter. I have the capacity, and my partner has the capacity to take on, definitely three more deals at least, probably 4 to be candid, between the 2 of us. So it's more finding the right deals today. In the market over the last, I'll say 90 days, especially maybe 100 days, has really picked up. So it's good for us as independent sponsors for sure.
Oh, what do you mean by that? The market has picked up.
So, I think 2024, the way I would describe it, quantity of deal flow was there. Quality of deal flow was poor. I told you we look for B assets. A lot of the assets we saw were C or below, to be candid. In 2025, volume was a little low to start, I think, because, and it's typical early part of the year. Also, when you have a new president that comes in, a change in office at that level, there's a little bit more of kind of a wait and see. So that was, January and February were, and I don't have the numbers in front of me, but they were definitely lower than January and February of 24. So there was, truth be told, a little consternation of, is this going to be a year where there's just not a lot of deal flow? Kind of almost similar to last year where there wasn't a lot of good deal flow. So, it come early March, mid-March, the quality of deal flow picked up and the volume picked up. So, I think there's been a little bit more of understanding of the market or understanding of, the environment we're in today. And especially for what we focus on.
In any deals that you're working on?
We're working on a couple that are, we're working on, one in the tax preparation space. We're working one on the roofing space, and then we're working one in the electrical services space.
I wanted to go back on a couple of things. The first was that you said a Rolodex was an actual thing. Here I have heard this term for so many years, and I thought it was just like a term. And I now know it's an actual item after Googling my way around. The other thing, more seriously, I wanted to go back to is 5,000 deals a year. It's almost impossible to imagine how much that is. That's 100 deals a week, 50 weeks a year. Take Christmas off, And so what's the filtering process? Can you walk us through the steps, the funnel, how much is kind of thrown straight in the garbage, and who processes what, and at what point do you and your partner get serious, and how many LOIs did that lead to, and just like really get to the nitty gritty of it.
Good question. So of the 5,000, I'll tell you that 90% never see the light of day. Based on just the header of the deal, based on the size of the deal, like just on the one-page teaser. It's too small typically, and it's in a sector we don't pursue. So 90% are gone.
But you view the teaser in the email. So you have cultivated some sort of engine where you receive 5,000 deals into your network, into your email, but 90% of them you won't even act on. It'll be archived right away. What kind of CRM do you use for tracking all these deals?
We're using Salesforce. We're actually looking, we're analyzing a few new solutions because it just wasn't, I didn't find Salesforce effective for what we were doing as independent sponsors.
Which other solutions are you looking at?
There's a few. There's Pipedrive. That's one of them that we're really looking at, that we're spending some time on. I'd have to talk to our analysts. There's a couple other ones that they're going to demo and show to us, but I don't have those off the top. But Pipedrive is one that we definitely talked about.
So then you're down to 500 deals. 90% has been filtered out. What happens with those?
We try to target 50 IOIs and 5 LOIs per year. That's generally like the rule of thumb, 1%, 10%. That's assuming, again, in 2024, we didn't do that on the IOIs or the LOIs. And it's, goes back to the quality of deal flow. So that metric is what we judge each other. We judge, on a quarterly basis on, because each quarter is a little different in terms of deal flow and stages. Q1, like I said, is a little light, and Q2 and Q3 are really ramped up. So that's kind of step one. That's how we measure ourselves. We expect because we're value-based, we know that a lot of our IOIs get rejected because maybe we're just too low on multiple, and we're okay with that. We're valuing these deals on an operational model, not a leverage type situation, so to speak. That's our modeling. Of those 5 LOIs, we expect to win 2 of them, typically 40%, which to some people seem high, but at this point, we've had several conversations with sellers, bankers, brokers, whatever it might be. We've built out a pretty good thesis. We, have strong conviction that our LOI, that the terms of the LOI match what they're asking for.
And so, Neal, obviously with this deal flow, none of it's proprietary, or I'm sure you occasionally have proprietary.
There's a small amount that's proprietary, correct, but it's not even 1%.
Right. And the deals that you have closed have been through they've been on market?
They have been. Yeah, we've not done any proprietary deals.
So 1 IOI a week. So you hope of the 50 deals you get a week, 1 is worth pursuing. At least at the right price.
Correct.
Yeah. Mm-hmm. Do you think that that's a higher volume of deals that you're looking at than typical sponsors?
I don't know. I mean, maybe for newer sponsors, yeah. But, for established sponsors, there's a ton of sponsors that have been doing it for 20 years, let's call it. I don't know. And it depends on their thesis and their focus. Some of them could be just focusing on add-ons,
Sure.
So for us, it's a mix of portfolios and add-ons that we're looking at.
Are you actively adding more brokers and bankers to the system so that you get even more inbound? And how do you do that?
We're not, candidly speaking today, adding more brokers or bankers. There are some new bankers or brokers that'll send us deals that we just add to the CRM and we'll do the outreach to. But we're not actively, in terms of, our strategy today, we think that we have enough deal flow, quality deal flow coming in. I think if 25 mirrored 24, we may think about it, not from a quantity standpoint, but from more of a, hey, look, the deals we're seeing from these guys just don't match what we want. Let's go look what's out in the market, so to speak. But no, it's not a strategic initiative today.
Neal, let's do a little bit of a thought exercise, changing topics a bit, to had you stayed in corporate, versus this path.
Mm-hmm.
You've been at this since your first deal was 2019, so you started in 2017, but had been in business school before that, right? So when did you exit corporate?
20, I left a venture firm at the end of 2016, roughly. It's just before, so roughly 2016, early 2017. Just before I started becoming an independent sponsor.
And so where do you think you might be had you stayed on that path versus where you are today? And doing this for the benefit of many sponsors who are so often mid-career, but especially those who don't necessarily come from a private equity or a deal background, where becoming an independent sponsor is much more of a pivot and much more of a life decision or a big career decision. How do you when you counterfactual what life might have been, how do you think about it?
There's pros and cons to everything you do in your life. I think the pro is, as an independent sponsor, I got to do what I loved. So, you're part consultant as an independent sponsor because you're learning about different deals. You're part operator, which I've had a background, which I love. I got to leverage my MBA experience. So I got to do all of that. That's the pros. The cons are there's no steady salary. If you were to compare that to, if I worked in corporate today for 7 years, almost 8 years, let's say from the time I started, would I be making more money annually on a salary basis? I would assume so. I would, definitely think so. But would I have the same passion, the same desire? Probably not. I didn't. I've outside of my starting career as a consultant, this is the most fun I've had, and I continue to love this career choice. I think, at the end of the day, I always told myself that if I played the long game properly, which is find good quality deals, find good quality partners, that carry would make up for that, let's call it salary compensation shortage, supposedly. And, this is hypothetical, right? I don't know exactly what my salary would be, but if I were to just take that same trajectory, I think I'm underwater a little bit. But that's okay to me.
Well, and let's take out carry. So you've got your four portfolio companies. If you could get to, you said you have capacity for another 3 or 4. Let's say Forge Capital got to a portfolio of 8 companies. Do you think that just from the management fees that you could catch up salary wise? Again, putting aside carry now, just to salary by salary, could you catch up?
Oh, definitely, 100%. Yeah, I think based on the average deal size, right? It matters on deal size because your management fee is based off the TTM EBITDA. So based on an average deal size, I would say yes.
Well, if you get there, and so your salary is on par with where it would have otherwise been,
right? And
you have carry to look forward to,
right? And
you're loving what you're doing. I mean, you actually have the passion for this. You're enjoying this more than anything else you've ever done, other than your first year as a consultant. It sounds like a triple win.
It is. I get to, I get to have my cake and eat it too, so to speak.
Well, let me experiment the math on that a little bit. So if you have 8 portfolio companies, and let's just for easy math assume they have 2.5 million in EBITDA each. And I would guess across a portfolio of 8, it would be much higher. Your first deal was 7 million.
Right.
But that would be 20 million of EBITDA, and your management fee is typically around 5%. So that would be 1 million a year. You split that across 2 partners here. You have expenses, you have analysts, but your take home would be a decent 6-digit number. An MBA on a C-suite career track would be definitely well into the 6 digits as well. Right. So this is with my pretty conservative estimate on EBITDA, but this is how you get to at least pari passu on the salary part, Will.
I think you're spot on.
Yeah, maybe another way of thinking about this question is like, say I want to be taking home $500,000 a year.
Sure.
What does my portfolio need to look like? How much EBITDA, and we can do that napkin math really easily.
Right.
How much EBITDA do I need to get to be taking home after expenses for my analyst for the firm?
Right.
$500,000 a year.
I mean, if you're asking me what that math is, I would budget, 25 to 30 million of EBITDA total. You don't need to have a big team to be an independent sponsor. That's the beauty. I've managed big teams. I don't miss it in a lot of ways. I enjoy having one partner and a couple analysts that are not full time today, and leveraging them up and down as our deal flow activity picks up or goes down. So it's a much easier process, and it frees up bandwidth too, right? From anyone that's ever managed people, they'll tell you a good portion of your day-to-day job is managing people and not doing any what I call value-added work. A lot of times I was babysitting as a manager.
So you don't have an aspiration, filling your capacity, your and your partner's capacity is kind of the goal. Beyond that, you're not trying to build some big independent sponsor shop.
No, that's never been my goal. I think, then you start, that gets to then, do you want to be almost a committed fund? And the answer is, I don't think I want to be a committed fund. Can you have a big team? But the drawback is if you have the bigger your team and you don't have guaranteed deal flow, income coming in, right? Yes, you can predict your EBITDA and you can predict, you can have some predictions around what your compensation is, to your point. But if you scale up and company goes south, or you don't close a deal or something like that, or a couple deals, whatever it is, you're laying off people. It's a lot more, volatile to me, right? Yeah. So I enjoy a smaller team. I enjoy, I think if you're doing it, at some point compensation has to be enough for your, to whatever quality of life you want, right? If all you're doing it for, to your point, is to do 30, 40 deals so you can make, 2, 3, 4 million a year, whatever that number is, that's great and no debate. But is it are you sacrificing your quality of life, right? Because that means that you're spending even more time doing non-value add stuff, right? As an independent sponsor, you're working north of 40 hours a week with a small team. With the larger team, the notion is, well, you're going to work less because you can offshoot. I make the notion, no, you have to work harder to close deals because you have more mouths to feed. And you also then have to spend more time managing those mouths.
Well, Neal, I'm reminded of the word that comes up seemingly in every episode. The biggest selling point of the independent sponsor model: flexibility. You can choose to be big. You can choose to be small. You can really craft it to the lifestyle or to the hunger level, to the to the financial goals that you want.
100%. That is one of the beauties. The flexibility, not just of the job, but the flexibility of picking the deals that you want to pursue, right? I don't have a mandate that I have to, deploy 50, 100, 200 million of equity next year. My mandate is, what I think makes sense. If I don't think it's a good deal, I don't want to pursue it, whereas I think if you're a committed fund and, you're like, we're, 2 years into this, into fund whatever, and we've only deployed 30%, let's say, and we have to deploy at least another 30, otherwise we're in trouble from our LPs, then, all of a sudden you're starting to do deals because you have to do deals. And I've never looked at a deal to close because I had to do it. I looked at a deal to close. I thought it was a great company to buy.
We're wrapping up here, Neal, but wanted to have you speak directly to the value of the peer group that you're in and your partnership. So two different subtopics of the topic of not going it alone in independent sponsor land. I'll start with the peer group. Just say more about the value there, because you teased it or you touched on it before when we were talking about the unfortunate first capital provider,
right?
And how now being in that peer group allows you to, for example, get feedback on a name or two and
Sure.
do some informal vetting. What else?
Well, I think we talked about flexibility just a minute ago, but flexibility and let's call it solitary are different words. And I look at it, having that community of independent sponsors to talk to say, hey, look, I really need help in getting this deal sourced, or not sourced, but, getting the capital around this deal. Who's a good group to talk to? And then, you'll get a bunch of responses of, hey, look, talk to he or she or this group or that group, and I'll be aware of this group or that group, whatever. You'll get the whole 9 yards, and that's great. You'll get the Cliff Notes version from people that you can trust. the independent sponsor community is not, to me, competitive at all. I look at it as collaborative. I always have. I had a call last week, I alluded to, we're looking at an electrical services deal. I had a call last week with an independent sponsor that just closed an electrical services deal. And we were talking about, strategy of growth and what they were seeing in their market. They're in a different geography than we are. But, what their strategy was to grow and how that mirrored what we were thinking about and what they've seen in the first, I think they closed about 90 days ago, what they're seeing. So that, that's a great ecosystem to talk to.
Is that a peer group in particular that you're involved in that is public or semi-public that people should know about?
It is not. I don't know if it's public or semi-public, to be candid. I'd have to talk to the guys that created it. But it's a wonderful group. The sponsors that created it and allowed me to be a part of it. It's been great.
And what form does it take? Is it like a WhatsApp group? It's just
got a website? We have a quarterly Zoom meeting. There's no real website. It's a quarterly Zoom that we speak at and exchange notes through email and phone calls. And I can say I looked at a deal last year and we were struggling to get it funded. We ended up walking away for different reasons, but I called a couple independent sponsors and they'd given me great capital providers that would be interested in the deal. To go back to that second part of your question around partnerships, we all inherently have some sort of confirmation bias when we look at things, right? It's natural. None of us are completely unbiased individuals. So we have things that we like and don't like and a little bit of a predisposition to. Having a partner that can that's a two-way street of respect, right? One, you have to have that. But two, that can call you out to say, look, this is a bad deal and this is why, and vice versa. And having that, I call that ping pong type conversation, I think is great because you educate yourself more. You start to see things differently. It's a somewhat of a form of continuing education of how you look at deals. And then the other part is, intrinsically, you don't feel isolated. I moved away from working from an office to working from home because I spend a lot of time on the road and the value of an office just didn't make a lot of sense from a cost perspective. In this day and age with Zoom and technologies like that and, an airplane and internet, most of my job is taken care of. So, it gets isolating if you're just on it alone. And, I respect independent sponsors that can do it themselves. I think it's amazing. I'm not wired that way. I like collaboration. I like bouncing ideas. I like somebody telling me that my idea is crazy and stupid. I kind of enjoy, I enjoy it. I mean, maybe there's something wrong with me, but I enjoy learning. And the only way to learn is if, what is it in sports? You learn more from your losses than your wins. It's the same thing. It's a very similar analogy to me.
Where's your partner based?
He's based about 20 minutes from me. So it's great. So
do you guys get together in person?
We do, which is even better, right? That face-to-face is great. So we'll see each other at least once a week. And it works out. It could just be an hour at a coffee shop bouncing ideas, but, it generally ends up being longer because then you start, I call it water cooler talk. But I think there's a value to it. We call water cooler talk.
Well, this has been great. Neal Doshi, thank you for coming on the Minds Capital podcast. If people want to reach out, maybe some lonely independent sponsor, what's the best way? Is it LinkedIn?
It's probably LinkedIn. LinkedIn's probably the easiest way to get a hold of me.
Okay.
I generally am pretty responsive through that.
Well, Neal Doshi of Forged Capital, thank you for coming on.
Thank you, Will. Thank you, Nicholas. I appreciate the opportunity and the time.
Hope you enjoyed that interview. For more like it, subscribe to Meeting of the Minds wherever you listen to podcasts. You can also watch us on YouTube. And check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. Minds Capital invests equity in independent sponsor deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about partnership opportunities and future fundraises. See you in the next episode.